Robert here. Welcome back to the channel. So many people are dealing with the barrier of down payment and or closing cost. Today, we're going to give you a 10,000-foot view of the Texas Department of Housing and Community Affairs down payment assistance offerings. My name is Robert. On this channel, my goal is to simplify the home loan process. Take a few seconds, hit the like and the subscribe button. It really helps out the channel, and I thank you in advance. Watch until the end, and you will get a very good understanding of the programs so that you can make the best decision for you and your family. The main two products that the TDHCA program offers is the My First Texas Home and the My Choice Texas Home. For the My First Texas Home, the target is exclusively for first-time home buyers. The income of those first-time home buyers, is going to be used for everyone that's on deed, plus any non-purchasing spouse. Stated a different way, in Texas is a community property state. If you are legally married and you're looking to do this loan program, say a FHA loan, and you're not going to qualify or use the income of your spouse, but you're qualifying with your income and all the debt within the household, well, for this program particularly, we're going to have to take the income of your spouse and make sure when you combine the two, yours and theirs, that it does not exceed the income limitations for the program. Okay. And so the limit, there's an IRS tax exempt limits apply. Okay. So for the IRS version, if you will, and then it's structured over a 30-year fixed, either government insured loan, FHA, VA, USDA, and or conventional FHA, not FHA, but conventional meaning Fannie Mae or Freddie Mac, pardon me, plus down payment assistance options. Okay. And just to go back, the IRS tax exempt limits, that's for what we call the mortgage credit certificate. We'll explain that later. On the opposite side, when you look at the My Choice home, the target are repeat buyers or anybody that's not a first time home buyer. As you can see here, no one that has owned a home within the most recent 3 years. The income, however, is only the income that's on the application. As an example, as I gave earlier with the FHA, if someone is qualifying, well, I'll use a conventional on this example, and you're in Texas and you choose not to use your spouse's income, well, then we're not going to reach out and grab that income and make sure you're within the income limitations. And so it's whoever is on the application. Standard program limits, meaning the maximum purchase price limits for whatever program that is that you're going to use. And it's a structured 30-year fixed interest rate with down payment options. So that's the 10,000-foot view as far as the two types of offerings and who they are applicable for. Let's move on. Now, the next flavor, if you will, of the down payment assistance, and I alluded to it earlier, is the mortgage credit certificate. And so this is a great first-time home buyer benefit in that it allows you to take a portion of the interest that you're paying monthly and use it as a dollar for dollar credit. Stated differently, if you had, say, $1,000 worth of mortgage credit certificate that you earned 1 year and you had $1,000 tax bill, you could take that credit and pay your tax bill. So it's an awesome program, and it also effectively lowers the interest rate that you have when you first start off with your loan. As the example shows, you take the annual interest paid multiplied times the credit rate, and this equals your tax credit amount. There's a combo option of this, meaning you can get this along with the down payment assistance if you qualify. And as the recording of this video, that credit is 15%, 15% of the interest that's paid for the life of the loan. okay, then that's what you would get. But that's the first flavor. The second flavor is the standalone. And as you can see, the difference is if there's a standalone option only, meaning you're not going to use the down payment assistance or anything, the down payment assistance that you're going to use is just the mortgage credit certificate. That fee has increased to $1,000. It was less, but now it's $1,000. And then lastly, there's a concept called recapture tax. The good news is this: three things have to happen. Three things must happen before the recapture tax could even come into play. And over a 10-year period, the amount that you would have to potentially repay declines as time goes on. The most you would pay is if all three things happened, and year 5 would be the highest amount that you pay. And then from year 6 to 9, it just declines until whatever that credit was dissipates. So if you think about it, this is another tool that's used to help benefit those of you that want to get onto the property ladder, that are in a certain income range, as well as first-time homebuyers. That's what you need to know about the mortgage credit certificate. Let's move forward. Okay, let's briefly touch on what your criteria, your eligibility criteria would be if you're someone that's interested in this. Again, my choice, or my first Texas home, you have to be a first-time home buyer and you have to satisfy that rule, meaning no ownership interest in primary residence during the most recent 3 years. And that's mandatory for the My First Texas Home and the mortgage credit certificate, regardless of if you're getting them in a combination or standalone, like with the MC. Now, there's exceptions, and I guess we can get into it from a 10,000 foot view. But if you're a qualified veteran, okay, meaning we have that DD 214 and you meet the requirements there, or if you're buying a home that's in a targeted area. A targeted area is simply an area that meets certain economic criteria. Secondly, residency, okay? You must meet the FHA, VA, USDA, and or Fannie guidelines, conventional guidelines, as to establish what residency is. You got to be a resident of Texas. And then there's an additional new rule that first-time homebuyers must reside in Texas to qualify. And there's a verified, and this is verified, by an affidavit of residency. That didn't always used to have to be the case, but you know how it is. A few bad apples mess it up, but not a big hindrance if you're following the rules. Easy peasy, pumpkin squeezy. Education is the third leg that you need to understand for criteria. And there is a HUD certified homebuyers education required class for at least one of the borrowers. The whole family doesn't have to take it, but at least one. And then this is also an update that non-purchasing spouses is no longer required to take the course. And that was effective as of the 5th of December, 2025. So making it very easy, if you will, especially if you're dealing with someone that understands how to navigate these things. And it's not a lot of heavy lifting because home ownership is encouraged. Okay, let's move forward. Now, I think it's a good time to just reiterate the income calculation mindset of the logic, because this is where really the rubber meets the road. We're going to assume credit and everything is intact, but this is where I find a lot of people have a lot of questions. So here's the logic. When you select the program, if you're a first-time home buyer, you go to the left. All right. The deal is this. We're going to take the income of everyone that's in your household over 18 that's working. It's the best way I can identify it. Okay. And so you can see we're going to include the gross income of the applicant, the spouse, or anyone living in the residence. Again, that's over 18 and working. And the non-purchasing spouse, if you do one of those type of loans and your spouse is not going to be on the loan, the income must be included. On the right side, if you're not a first-time home buyer and you're doing a My Choice Texas home, we're only going to qualify you with the income, whoever is borrowing the money that's on the application. So you can have a spouse in that instance and not have to add in those monies to meet what the income limitation is for the area that you're buying. So as you can see, it says it includes only the income used to qualify for credit. Non-purchasing spouse income is excluded. Okay. And one note there's an exemption for the Fannie Mae HFA Preferred and the Freddie Mac HFA Advantage. You must include the non-occupant cosigner for any income that's 80% of the area median income. The spirit of the loan is to make sure that those that would not otherwise be able to get onto the property ladder can. It levels the playing field. If you have further questions about it, just reach out to the lender that you know, like, and trust. If it's us, our contact information will be pinned in the top comment of this video and or the description below. Reach out, let's have a consultation and get you good to go. Let's move forward. Now, here's another area that a lot of people have questions about, and it's called the targeted areas. Single family, condos, planned unit developments, HOAs, manufactured, real property that's titled or fixed to the land. You could have duplexes that must be 5 years old unless they're in a targeted area. So those are the types of properties that can be eligible if a property is in a targeted area. Okay. Now there's some land restrictions. So there's a maximum of 1 acre. Can't go out and buy a compound for the family if it's over 1 acre. And this is strictly enforced. There's no gray area, right? Now, there could be exceptions. So you want to reach out with someone that understands these programs so that you're not wasting a lot of time and money to make sure what you're thinking is going to work. Last but not least, business use. You cannot have more than 15% of the residence usage as, say, a daycare, as it gave in that example, right? So you guys could do the math on that. If you have one of those types of things and you're looking to do this, it's not a no, but it's not for businesses, right? This is for primary residences, for people to live and raise their families. Let's move forward. Now, here's a great example of how down payment assistance loan is structured whenever you're using a down payment assistance and using it in the form of a second lien. Okay. So let's say you're getting a DPA assistance at 5%. That 5% will be held as a second lien. Okay. As a second lien. And as you can see in option A, it's a 30-year deferred repayable, 0% interest, no monthly payments, repayable upon sale, refinance, or payoff of the first lien. So that's huge to understand because there's other programs in the state that do not require you to repay this monies. But in these programs, the state issued ones, it's going to be repayable. You have to repay it back either when you refinance or down the line when you pay it off. Those funds come back, okay? Or option B, there's a 3-year forgivable. Now, if it's forgivable after 36 months when you come in, that second lien is also going to be at 0% interest. It's forgiven 3 years if current on the first lien and the house is still occupied as a primary residence. So if you break any of those things, you have to repay those monies. The point of the program is to help, not to pay or absolve you from different costs, things of that nature. Okay. So now gift funds, monies that you get from a qualified gift source, are available with specific partners, right? And as this is saying, like Harris County, and there's a couple of other counties that might have additional funds that you get on top of these programs. If you qualify, your lender should be able to walk you through that at the time of your qualifying and application. Let's move forward. So here, what you're looking at is just a 10,000-foot view of what an underwriter is looking at. And these are some of the more important things, but credit and your DTI, debt to income ratio. So minimum credit score of 620, that's the minimum, okay? 0 scores sometimes are allowed depending or determined by the representative score via agency guidelines. So for the most part, guys, you got to have a 620 credit score, but they got to put the full disclosure on there. But more times than not, 620 is what gets you in the door, starts the process, okay? And then the debt to income ratio, as you're seeing here, standard AUS, automated underwriting system findings for manual underwrites. Okay. The max DTI is 45%. And then if you get a regular approved eligible, you're going to be approved with whatever income that the automated underwriting system approves you with. I've not seen anybody on conventional more than 50% and FHA 55%. Again, you got to ask yourself that question, though. Is that something that you really should be doing, stretching yourself that thin? That's a different conversation. So remember, manual underwriting policy allowed only with VA and USDA loans. There's no manual underwriting for FHA and conventional loans. Okay. It's not allowed. So if you're VA, USDA, and you can meet the manual guidelines for the DTI, the debt to income ratio of 45% or less, you're good to go. If not, then you're going to have to come up with a different plan, you and your lending partner. Let's move forward. So the last thing I want to hit on this video is a big one, because as you can see, effective as of January 1st, 2024, there was a payment shock overlay applied, if you will, to these programs. And I think it's a good idea because we really want to protect you all as potential home owners, not to over leverage yourself. And so here's the deal. The calculation for payment shock, and it's the same one used for FHA. As a matter of fact, that's where they got it from. But if your current rent that you're paying, okay, and you take that and multiply it times 1.5 times, and if that equals the payment increase threshold, this is what happens. In scenario A, you get a green light icon. The proposed payment is less than or equal to the threshold. So there's no reserves that are required. If you exceed, if your current rent times 1.5 times, right, is more than what you've been paying, then you go to B, the red light indicator, and you must have 3 months of reserves in a qualified account that we can verify. That's easily stated. And the deal is, this is to protect you. And so if you were in a situation like this and you didn't have the reserve, the natural mindset is got to come down in purchase price to stay within that 150% increase from what you've been paying, because the numbers show that's something that you can comfortably stretch to, right? And also note, first-time home buyers with no rental history automatically require 3 months of reserves. And again, this is to protect you, because when you get into a home, it requires money. Things happen, and we want to make sure that you're able to meet and exceed what potentially can come down the pike when you become a homeowner. As you can see, the Texas Department of Housing and Community Affairs has several options to help those Texans and those folks coming to Texas, because there's a lot of folks doing that, overcome the barriers to getting into a home. If you are interested in programs like this, or this one in particular, and you're ready to make that step, as I stated earlier, my contact information is in the top pinned comment in the description below. I'm a lender, NMLS license number 180100, and I've been doing this for 23 years. Would love to have a conversation to see if we're a fit. My time is up, but I thank you for yours. As I always say, guys, let's be good to one another. Let grace abound. Watch these next 2 videos. They'll help you in your education and preparation to become a homeowner. And until the next time, indeed, y'all stay blessed.